Hello, everybody, and welcome to another week of the Build Weekly Roundup. This is for week 26 of 2025. Over the weekend, we've had a lot of new developments in that Iran-Israel conflict. I think the big news for everybody, if you've been living under a rock, is that the U.S. has joined the fight. We did drop some bombs into Iran, so a lot coming out of that Matt and I will be able to discuss with the group here today. And then moving forward from there, there's been continued discussion from Trump about interest rates needing to come down, pushing Powell to make a choice, make a different choice than what he's doing so far, and trying to find ways to pressure him into lowering those rates. And then finally, continued discussion over privatization of some of these government, special entities, specifically Fannie Mae and Freddie Mac, is what Matt will walk us through today. So, without further ado, let's go ahead and just get started with it. I can kind of cue us up for this next slide here really quick while I transition us. But essentially, there's been a lot of talk previously about Israel having really deep connections within the Iranian government, through their Mossad, through other methods, and I think you're just starting to see the surface of what they're capable of coming to light. So Matt, you pointed this out. Walk us through kind of what happened with Big Sapa and how it started and how it's going.
Okay. So this week, I think it's hard to get across this notion, or even just pick three topics to describe all of the key elements that have developed in the big picture plot narrative that we're going through, right? That we talk about on the longer term time horizon, not just months and years, but decades, century type of stuff that we're living through. But maybe I think it'd be helpful to try to give a little bit more context in the fog of war, because that's what I believe we are in right now. To get your bearings right on what in the world is going on here, because we do see all of the breadcrumbs are out there in the key headlines, but if you don't consolidate them and put some basically anchors in the ground to put a foundation on top of the house that you're building, to understand what we're getting through, and then ultimately how to invest through this uh, big transition. None of this will make any sense, right? So the narrative that we've been kind of flashed, in the last week was, obviously, the developments with Israel, leading the actions against Iran up until this past Saturday night, right, where we basically decapitated. If you start with the IRGC leadership, nuclear scientists, AI scientists, and then just really kind of precision attacks. One of those that I think is key, that'll tell you who is actually at war here, what's going on in this kind of battleground of in this broader confrontation that's been Iran, and that's been developing towards something like this for 20 years, ever since those nuclear discussions really got underway in the post 2001 environment early on in the this has been going back to the George W. Bush administration and probably even before that. So I think the key that is getting overlooked in a lot of the headlines, obviously the B-2 bombers going in and dropping, was it 6 of these massive ordnance penetrators? Cameron,
Yeah, I
is the
believe
total
so.
6?
Yep.
Yeah, on the Fort Dow facility. That's what's getting all of the attention and the headlines, because it just makes sense, right? This is an actual U.S. strike, like military strike, on U.S. or sorry, Iranian government facilities. Um, so obviously that would make the most sense. But I think if you want to actually dive deeper and understand the entire plot arc, and make some sense of this, I think the actual clarifying event and what's going on here is in this cyber attack. There were 2 of them conducted. One of them was on this Bank Sapa, one of the largest Iranian banks, which apparently wiped out its its ledgers. And then on the side of that, you've also got the cyber attack and wipeout, deletion of records, and theft of cryptocurrency assets. That the only one that matters, in our opinion, is did you get away with the Bitcoin? And that appears to be the case. But a 90 million cyber heist of Iran's largest cryptocurrency exchange took place as well. So in one fell swoop, you deleted the legacy, FX ledgers with the largest bank in Iran, or one of the largest banks, and then you kind of crippled its capital infrastructure on the Bitcoin paradigm. Which, if you follow, what we've been saying week in and week out, we've been pretty well consistent about this. Bitcoin is your new capital infrastructure. As we move forward in this transitionary development. But I think just going in a little bit, what was this Bank Sapa? Because you're not seeing many headlines about that in the op-eds, the narrative discussion about what's going on in Iran. So I want to go through and spend a few minutes on this, and I think this will enlighten your understanding of the situation. So what is this Bank Sapa? It was actually formed in April 2020 out of a merger amongst smaller banks that were critical to Iran's military infrastructure. So who does that mean? See, Iranian Revolutionary Guard is the core here. And I think it's also important to realize there are different factions, same way as in the US, there's not one political faction. There's not one US. Within the US, there's there's different interests that are, I should say, battling between each other for control of the important institutions, government seats, etc. It's the same thing in Iran, and one of those, right, the key one, the military, which is really, if it the way this looks, it looks like the IRGC is the and their energy infrastructure, in tandem, are the key kind of factions or power holders within Iran that have been pushing for this nuclear weapon. Now, and then from an international standpoint, who else is kind of beside them? Who wants to? Whose interest is it in to keep this issue, which is just a continual, just kick the can down the road. It's what would you call it? Like, Iran's been 2 weeks away from a nuclear weapon, right, for the past 20 to 30 years, right? Who benefits from that?
Right.
And so if you see this wipeout of the banking infrastructure, right? If you lose your monetary kind of abilities and ability to settle with counterparties. We've talked about in a war, right? If you can't fund yourself, you're done. As soon as one side runs out of gold, or financial assets, etc., ability to raise debt, its own IOUs start to hyperinflate, all that. That's your sign that you've lost the war, right? You can't go procure what you need to keep your side in the fight. Okay, that's why this is so important. So what was this Bank Sapa? Who were its largest counterparties, right? Whenever you see, a bank, right, or a financial institution, you always have to think about who were its main counterparties, right? Who is dependent on this thing surviving, right? Why did it exist in the first place? So it starts with, right, it was a consolidation of, all of the kind of the military infrastructure within Iran. That was the core existence for this bank, or this financial institution. And its largest counterparties were actually kind of European, both continental and London banks. So if you dive into this article, and you always got to ask, who is your source, right? This is coming from, this article on the left, how it started, ifmat.org. This is, when you dive deep, who the heck are these guys, right? You read something on the internet, right? It starts, stands for Iranian regime, frauds, manipulation, atrocities, human rights violations, threats, crime, news, right? And if you really wanted to dive deeper into this, like it's probably state intelligence. It's someone's kind of pop up, right, to put this out there. But the point is, how do you find out what this thing is? Bank Sapa, why was it taken down? All of that. It was actually a counterparty of the, primary counterparty would have been in the EU. So this needs more verification and other outlets kind of confirming this. But what I've seen, and if you ask your AIs, your Perplexity, et cetera, what they return on their deep research as the largest counterparties here are actually HSBC, Hong Kong, Shanghai, Bank of China, operated out of the city of London. And this one was a surprise to me, the Deutsche Bundesbank, right? Which is
Interesting.
the central bank of Germany, right? So this Bank Sapa had a subsidiary outlet in Germany, right? That was its kind of foreign registered entity. So these were plugged into Europe, which should give you a lot of questions now as we talk about the Trump blessing. If you see the next step on the tweets, like of China being involved, and then you see this Bank Sapa, like whose counterparty was this? Well, this was primarily, from what it looks like to me, a European counterparty. Once those ledger records are kind of wiped out, if you're a counterparty of this bank, what does that mean? It means your IOUs to that bank are now, essentially, null and void. You've got to go through and recover, your claims against this financial institution, which is now, besides the international geopolitical conflict kind of heating up, it's now declaring, hey, that ledger's been wiped by Israeli hackers, right? So
This is
very interesting
actually, yeah, so this is
things going
actually
on.
wiping it out on the, so if you're European, your IOUs are being wiped out basically, right? You're saying you need to actually go back to Iran or try to find some way to say, hey, you actually do owe me, or do I have that backwards?
Well, so what's been wiped out would have been, so it's, if you're the Bundesbank, right, you still show Bank Sapa owes me X, right? But if I'm Bank Sapa, like within Iran, and I'm facing the counterparty, I say all of my, ledger has been wiped
I
out.
have
So
no way
all
to
of my
prove.
IOUs, I can't verify that I
Right.
actually owe you X. And then, from your point of view, right? How do you get someone to pay, right? Like these are all credit payments, right? So you have no idea what this liability is actually worth anymore. Um, and what you've essentially done is you've market this thing insolvent.
Right. I see.
Unless they can reboot their ledger, which kind of data storage, cybersecurity, like it does boggle my mind, right? If you watch movies like Fight Club, what are some other recent ones? Like the whole plot of the movie is you wipe out well, there's a much deeper plot of the
Yeah,
movie,
right.
but the actual like device they're working with, right? And in the real world was Tyler Durden character was both Brad Pitt and Ed Norton, but his kind of crazier side, the Brad Pitt side, was working on this scheme to blow up essentially the data storage for all of the US based credit card companies servers. So effectively, it just kind of decapitates the entire US credit bubble. You don't know what those IOUs are worth because no one can go and reconstruct the ledger. That was the plot. Whole point was you've got redundancies, you've got backups. This should be very hard to do, right? To actually um, just completely wipe this accounting ledger off the face of the earth, right? Because if there's no backups, redundancies, et cetera, I mean that just kind of defies believability, in
Right.
this in 2025,
Right.
right, where we know that is a massive risk. Um,
And I guess it remains to be seen what, the claim is that they've destroyed data, but then, to your point, is it just a temporary destruction? Is this, actually just kind of an annoyance for Iran? Who knows? But obviously they're trying to do something, which is what you're pointing
Yeah.
out.
So whose assets were this bank supposed liabilities? I think that's the key thing, right? Who did it owe money to?
Right.
That's where kind of the rubber meets the road. So doesn't seem like, I mean, U.S. sanctions, right? It's not going to be a U.S. bank. It's not going to be U.S. financial institutions. It's not going to be Israeli, right? I'm pretty sure they're not doing any financial relationships with Iran, and then you think China, right? Well, China, like the resources to Iran, this is a good time to go into the next slide. Um, the resources, yeah, okay, we talked about Battle of Fordau,
Yep.
maybe one more. Um, the resources to China are super important, right? Um, Iranian oil accounts for, the actual stats, maybe it shows 14% of the sanctioned Iranian or oil exports are going to China. But once you see the kind of just the re-stickering of those barrels, from Malaysia or other kind of export hubs, the actual imports of Iranian oil that are that, in China are probably a much higher share, and they're coming at a discounted price. So from a resources standpoint, China is very interested in those exports coming from Iran. So they'd be like heavily, what do you say, incentivized or aligned with the removal of U.S. sanctions and the resumption of business. Now, from a counterparty claim, would it make sense for Chinese banks to face this bank CEPA, right? And my kind of thoughts on that, if you look at China, all right, where would you stand on Iran, you know, going live with nuclear weapons capabilities? I would argue you'd be massively
You're
against that,
against, yeah,
right?
100%.
If you think about the Eurasian continent, right, and how many of the 14 nation states that border mainland China, if you think about it, you've always had Russia with nuclear capabilities. Those predated China's. But if you think about the developments over the last, starting in the late 1990s, right, you had Pakistan and India both flip on with nuclear weapons, capabilities. And then not fully acknowledged is my understanding, but I think with these, underground tests, it's pretty well confirmed that North Korea also possesses, nuclear capabilities as well. So if you're China, you've now got 4 out of 14 of your neighbors with nuclear capabilities. Well, what does that mean? It essentially means that the sovereign is entrenched and hardened. Now, Iran is not a bordering country to China, but still, part of the Eurasian continent. I would kind of, my baseline assumption is if you're the Communist Party of China, you do not want to see further nuclear proliferation, right? So an Iranian regime turning on nuclear weapons, going live, I would think you would be against
And
that
you
action.
did see some of this with, I believe it was a few, PR posts, things like that from the Chinese side saying, hey, we want to broker a peace. We want to make sure that they're not continuing with this nuclear program. Maybe let's try to sit down around the table there. So you do see that versus, I believe, I wish I could find the exact post, so I'm not just quoting out of thin air here, but I believe Russia was the one kind of pushing from their side, saying, no, like we do think it's their sovereign ability to be able to decide to go for nukes if they want to. So you are seeing some of this play out between those regional powers.
Yeah. But even still, like man in the middle, obviously, like the Eurasian continent, the big dogs are going to be Russia and China as your primary
Absolutely.
land powers. To turn on another country with nuclear capabilities, I don't know. Maybe you do want something to, balance out India, Pakistan, but I don't know if you let in or if you let Iran go live with nuclear weapons, you automatically are going to have to see Saudi Arabia as well because they are not going to tolerate,
So too close.
their antagonistic neighbor and the counterpart, the long-term foe that between the Sunnis, largely represented by um, the Saudi royal family at this point as their flag bearer versus the Shiites and Iran being the flag bearer of that branch of the Islamic faith. I don't think you're gonna like if you actually turn Iran nuclear capabilities on, um, it's really hard to see like where this the chaos of the branching in these decision trees actually goes. So I don't think anybody, China, Saudi Arabia, U.S. I do think it's pretty clear. You've got a huge coalition that would be against Iranian nuclear weapons, proliferation. And even if you say like, okay, Bank Sepah being a large, what looks to be a European counterparty, even still, if you say like if it's in the interest of the EU, like if you look at it from this perspective, it's all about the Iranian natural resources, right? You need
Yeah.
more base layer collateral in your economy. At this point, like Iran doesn't have the capabilities or the wherewithal to push back to much of any extent against the other kind of superpowers, the other societies it's butting up against.
So, maybe help me.
Yeah,
I was saying,
go
so
ahead.
maybe help me understand how this then reflects into markets and capital markets, because I think the
Yeah.
obvious first step is oil, which Trump has, called out specifically here. And last week you mentioned we didn't see a spike in oil prices as much as we expected because the Saudis turned the spigot back on. A lot of talk about Strait of Hormuz, etc. So maybe walk us through your thoughts
Saudis
there.
turned, yeah, Saudis turned kind of the excess capacity on, made it live. And then also you've got, low oil prices are kind of a symptom of you know, low global growth, right? You look at things like Dr. Copper, also oil
Demand
price,
down.
like
Yep.
those are indicators of demand. That's correct. So, all right, put these together, right? Think all these pieces you have in the mosaic, right? Zoom out and then look at what you're seeing. So, what have we been talking about, 4 weeks ago, right? The headlines coming out were all about. First, we started with the Geneva meetings between the U.S. and China, and then they went to London, right? This was 2 to 3 weeks ago, right? As they're working towards these talks. And then this week, what do you get developed, right? Buried below the fold after the Fordow kind of strikes, which get all the attention, right? With it's obviously shock and awe. If it bleeds, it leads, right? Under the hood, though, you get this tweet from Donald Trump, um, basically saying, just China, you're good. Continue purchasing oil from Iran. Um, Also, please buy some from the U.S. We have best price, so that type of thing. But if you look at what's actually going on, right, or what was agreed to at these talks in Geneva and then London, these are the bullet points. I've said this, like whatever has been discussed and agreed to is not going to be printed at that time in the headlines. It would kind of unfold and be revealed to the broader public as those future developments kind of come to light, right? And so what you're seeing now, all right, in the global oil trade, read the book The Prize, the market share of hydrocarbon supplies, oil and nat gas, are mission critical to global development ever since, Colonel Drake figured out how to drill for oil out of the ground in Pennsylvania, like in the Civil War times. This has been kind of a natural resource that has been key to economic growth that nation states are fighting over, access to markets and distribution for the entirety of the 20th century, and it continues to this day. So this bullet point here, everything we saw develop, starting with Israel, the precision attacks conducting against Iran, the U.S. kind of coup de grace on Fordow, and then you see the banking kind of side of those you call it military actions, but it's just a war action, right? The financial landscape is just another arena for war, right? And so now you see, hey, China, is basically brought into the fold. It's like, all right, where does China line up in terms of its interests here? It's right with the United States, and this is why you haven't seen, in my opinion, a massive public outcry on what the U.S. just did from CCP leadership, right? This is, they've been read in, is what it looks like to me.
I think that makes sense, yeah, and especially with what you've been seeing, like I mentioned before, that they definitely do not seem like they're pushing for, any type of Iranian nuclear program coming back anytime soon. And so, you briefly mentioned, I know we don't have any slides on this today, but you mentioned that Hong Kong dollar also kind of hit the opposite end of its peg, and I'm curious,
Yeah.
how does that relate to kind of these puzzle pieces that you've been putting together?
Okay. Yeah. About 5 or 6 weeks ago, this was at the end of April, where we did a big episode where the biggest thing we saw happening was what was going on with the Hong Kong dollar peg. It actually strengthened too much. The HKD peg is kind of in a managed range between 7.75 and 7.85 Hong Kong dollars per US dollar. It's been managed on a peg, I mean, for my entire lifetime, 36, yeah, 38 years, or getting close to now. And what we saw at the end of April was, as the tariffs kind of started to bake in, the Hong Kong dollar actually hit the strong side of that range of 775 and stuck there. And what does that mean when the HKD, what is the purpose of the Hong Kong dollar? What does it exist for, right? It's it's a currency that's, native to only the city of Hong Kong, right? The harbor city, and the large banks that operate there, like effectively what they're doing is they're the settlement of trade between China and the rest of the world, right? So all of the banking activity flows through Hong Kong, traditionally. Um, what you saw was the Hong Kong dollar, smashed down to the strong end of the range, 7.75. What actually that meant was there was a rush for liquidity, right? Because what happened with the tariffs is like, whoa, all of the US dollar flows into Hong Kong, that are kind of the flip side of an export from China to rest of world, US, Europe, et cetera. Because the US ports of entry were closed off to, it's essentially like domestic imports from everywhere, right? But mainly, who's the largest share of those, right? It's China, right? The largest exporter. Um, that 7.75 was kind of similar to like a 2008 liquidity rush, like where everybody is, in the game of musical chairs, rushing for reserves with the Hong Kong Monetary Authority, so that they knew that each one of these large financial institutions could meet its own liability obligations that they've entered to with their counterparties, right? The other banks operating within the city of Hong Kong, right? So what you've actually seen in the month of June is a reversal. That Hong Kong dollar peg flips to the other end. So instead of 7.75, now it's 7.85. I need to do some deeper research on this, but that flip from low end of the range to the high end within 6 to 8 weeks, this is encapsulated in 1 quarter, right? That's actually a sign of like massive volatility in that own, like in that existing infrastructure.
Right.
That's going to be extremely difficult, because if you're just flipping from one end to the other, you've got a real pickle from like a monetary board standpoint, right? You're always having to triage this, and eventually it's just going to get harder and harder, right? Because what did the HKMA, the Hong Kong Monetary Authority, have to do um, during April, right? What they had to do was actually supply like just ample Hong Kong dollars into their aggregate balance or their measure of reserves, make a bunch of HKDs available for settlement, right? Because if there's a rush for musical chairs, you don't want the music to stop and some GSIB or a large financial institution to go insolvent, because then you've just got a massive mess to clean up, and it's extremely expensive. What do? Just throw a ton of musical chairs out there. So when the music stops, there's plenty. So everybody has a chair. That's what they did. Ramped up aggregate balance, and then they also had to cut the HIBOR overnight rates to essentially zero. They're at 2 bips right now.
Got it. So you're seeing a
And
lot of that kind of basically easing on their side to try to get this back
yeah,
underway.
so now the Hong Kong dollar is actually saying it's the other end. It's actually too strong now, suddenly. Um, so you're gonna have to be in this kind of reactive step now, where instead of having to supply liquidity into this marketplace, you're gonna have to do something uh, like buy dollars instead. And part of that, like if you see this on the dollar chart, we have this on the do we have it on the next slide, the dollar?
We do.
Yep. So part of this is what's going on this massive bearish trend we've seen in the last, this is 2 months on the dollar, but if you zoom out, it's essentially all year. This is the dollar getting sold, right?
Yep.
And if you look on international FX, like which countries have appreciated the most versus the dollar, you've seen, I mean, it's across the board, right? But euros, but also the you call it the competing currencies to the Hong Kong dollar within Southeast Asia. So Singapore dollar, Taiwan dollar, et cetera. They've like out appreciated versus the dollar versus what the Hong Kong dollar has appreciated versus the dollar. So what does that mean? It actually means, in my opinion, like Hong Kong dollar now it has to keep up its share. Like it has competition within Southeast Asia. It's going to now have to respond to, possible like to avoid, its competing, financial money centers from, absorbing its share of business on, servicing international trade, merchant banking, et cetera. It it may require like further steps now, just across the board to keep pace with its own peers. So my point here, HKD, it's been one of the contributors to this bearish move we've been seeing over the last. I mean, it's really year to date, but especially since the Liberation Day Trump tariffs went into effect. But what you see in the HKD is actually going to be extremely important to this chart that continues to develop in the dollar, right? Which has been extremely bearish at this point. Another thing, so Trump acknowledging that essentially he's all good with China continuing to import Iranian oil. It's basically like what was formerly like black market activity is now going to take place out in the open. It moves from over the counter to something more publicly acknowledged, potentially. Um, those trades, oil for what, right? Are like what currency are those happening? Those are actually more and more happening in Chinese yuan, right?
Right.
So it'd be the CNH. So then if you think about it, right, well, that's activity that doesn't require, dollars to be held in reserve. So on that's also like, contributing to the weakness in the dollar as well in international FX.
That helps me put that into perspective a little bit because I keep seeing the dollar chart, the Dixie chart, and it does not look necessarily great. I mean, obviously it depends on what your goals are, right? But seeing more of that open trade with Iran for oil, things like that, not something I had necessarily put together based off that Trump tweet, right? But that's a good call out there. And so, to kind of move along here, we've been talking about the dollar. The Dixie's down, but Trump is still calling for Powell to cut rates. I think there's been a lot of movement in the last day or two on potential next nominees, things like that. But maybe kind of walk through what you're seeing. I think that the first market reaction here to this news has been rates down. You've got this chart here of the curve overall. So you know why the arrows there. I mean, obviously on the front end, you're going to see some declines in those yields, but I see the last point. So for our viewers, the green point is higher than 1 month ago, which is not necessarily what I might have expected.
Okay. So there's a ton of developments that are going to be packed in here in the next 2 months, as we head into September. Order matters, right? So what do we know already, right? You've got, the president, Trump, really berating Fed Chair Powell, right, to lower rates. What does he call him? His new nickname for him is what? Too late Powell,
Yeah,
right?
great nicknamer, by the way.
They're getting, they're getting, just call it, they're getting soft, like they're not punchy
Yeah, they're not
as they
as
were
sharp.
in the
Yeah,
2010s, right? 2010s, he was on it. I don't know, too late Powell, right? Well, what you've seen from you know the European central banks, you've seen ECB continuing to cut sharply. Swiss National Bank is at zero, right? BOE is they cut, but they're really following the same playbook as the Fed. They haven't cut further, right? And that kind of is a good sign, right? BOA seems very anchored. They've
they're following
tethered
what
their
we're
cart
doing.
to
Yeah,
the US's horse very closely, is what it looks like in my point of view. But you've seen pressure on Trump, like I'm gonna uh, not just continue to harass this guy to lower rates, but you're now talking about right nominating his replacement with like 10 or 11 months to go in his term, which expires next May.
right.
So this could happen over the next, I would say 2 to 3 months, where you already have the chair nominated in place, and you would have this talking head going out in market saying what he or she would
It's like
do
a lame
in
duck
rates policy.
Powell in the meantime.
Yeah, so you've got actual policy, and then you've got shadow policy of, hey, here's what things are going to look like starting next May for markets to respond to. All right, what bond markets are saying, right, and these are, as you think about it, what's involved in treasury prices, right? It's real growth plus inflation expectations is what this would amount to, right? You've seen treasury yields rally over the last month, right? And that's kind of confirming, if you will, like the slowing of the growth cycle, not just globally, but also the US. So the US domestic market specifically. Now, if you think about like what's going on, what are the key events over the next, I would say, not just 2 months, but next 1 month, right? It's this one big beautiful bill passing Congress and Senate and making it to the president's desk for signing. And so you start to look at that. When is that likely to come through? This is, the poly market prediction chart. You've got a 90% chance that it gets done by August 31, 86% chance. These are just market pricing, where these are trading. 86% it comes through by end of July, and then 72%. So roughly 3 times out of 4, it'll be done by the 4th of July, right? So this has to happen, one way or the other. The U.S. government is going to need to continue running a budget because, just where the debt ceiling is at, and federal deficits, the Treasury is going to have to increase the debt limit to continue operations, because we're not going to let the thing default, right? But as we head into that, you start looking at, all right, what needs to happen. You construct this in such a way that you manufacture lower interest rates, because, right, if you look at what these rate cuts, even the 100 bips of cuts we got in Q3 and Q4 of last year held steady for the last 6 months. Those 100 bips actually reduced the debt service or interest expense for the U.S. Treasury significantly. Now, another 100 bips of cuts are also going to deliver a similar just cost savings from the U.S. Treasury's perspective. And just because of the fiscal considerations, where we are with the debt problem, it's not a it's not an if but a when, right? We have to get cuts. President's serious about this. Like it's not just for um, his own good. Like he wants to pump his real estate bags or make the stock market go to the moon, like that type of stuff. Like sure, but from the debt standpoint, like it's a necessity. It has to happen. So the question is when, right? Well, you have to. If we go back to the Treasury curve, what's actually going on to get those cuts? Um, you have to time this up, the order of operations, right? Pass the one big beautiful bill, then cut rates, then you start to see the full steepening of the yield curve as the front end comes in, where you see that first hump of the kind of the square root or check mark sign that comes down, and then you start to see, like, we don't know where the long end or how that develops. Do those front end rate cuts create inflation expectations? My answer is probably yes, right? As we push up against the resources, against the U.S. economy's productive capacity. No, that's the other way around. They're going down. But yeah, long end, like, what do we see, right? When we cut 100 bips in September, what materialized? The long end sold, right? Because that additional, credit creation, that expansion, actually, the market was telling you that's gonna materialize into price increases in the economy or price inflation, which is, I guess like a, a term that it's like nails on a chalkboard when I hear it, because it's monetary inflation is kind of the definition I would stick to. But what you're looking here would be like at yield curve developments. We do get those front end cuts, right? Just assume those are going to happen because all of the interested parties, the key players here, chief among them the U.S. Treasury, but then also the large financials, they all want to see the front end cut, right? And just helps out the fiscal deficit situation. How does the rest of the curve play out from there? What you're seeing is, all right, the front end is now getting bid. You see today the 1 month is at 4.15. All of my, if you just track the key money market rates, what's happening, the weekly auctions, this week's 4-week bill closed at a high yield of 4, which is, if you look at it right now, the RRP lower bound is set at 4.25. You're seeing SOFR spike to, or it's not SOFR spike, but SOFR sitting at 4.33, still waiting to come in. And Fed funds also sitting at 4.25. So the T-bill is now telling you, hey, you can start to cut. Like this is what the financial kind of money center banks who sit on most of the T-bill activity, who are doing most of the buying of these massive multi-billion dollar issues that come out every week. They're now telling you that, all right, that front end is looking ready to come in, like bring in some more bips of relief on the front end. And then right now for the 2-month and 3-month, you're actually seeing those get further discounted at these treasury auctions. So 8-week bill you're seeing, and then the 3-month, those are trading at almost 4.4%. Where do those line up? Those are in August and September. And this is what you tend to see whenever we go into this, call it just fake stalemate. Every time we, like, Congress wants to draw out this process, make it look like we're not going to get some sort of debt ceiling extension or increase, right? It's going to happen. But the market, if you will, money market funds, et cetera, they charge an additional premium for the bills maturing in those windows where you could see, that cutoff date where the Treasury would have to soft default on a liability.
This is the little bump on the print saying, "Hey, there's some concern here. Probably gonna be fine, but maybe."
Yeah, you just kind of get out of the way.
Right.
So there's a little bit, but once that um, resolves itself, which will the way it gets resolved is the one big beautiful bill, passes, which extends the debt ceiling, like bill auction size, steps up. You're increasing auction size, so you're racking up more debt, but what you're charged is an interest rate on that debt on the bills portion, that front end, comes way down, right? So more debt, lower interest rate. From a cost standpoint, um, you're better off in the short term. It's terrible financials, right? This is
Right.
not what you like.
Not how
You're
you run a
running up your
business.
tab from a borrower's perspective. It's not good, but in the short term, it gets you out of your current financing pickle, right?
Right.
So what the rest of the curve is telling you is once we get past one big beautiful bill, right? Once that's done, debt ceiling's extended, rates come in, right? And what's driving that? Like what's your actual like forcing function to make that happen? It's um it's the health and state of condition for the domestic U.S. economy, right? It's growth, unemployment, and those would be your top two. And then third place, in my opinion, would be your inflation mandate for the Fed, which if you're looking at all the research sources, the best um, forecasters, in my opinion, they're actually showing an uptick now starting in July. Uh, so far post Liberation Day, we've actually seen CPI continue to come in on that kind of that broader trend. If you look at year over year CPI, um, since oil and copper rolled over June 2023, was it 2022 or 2023? I think it was 2022. I'm going to here. CPI has been in a downtrend essentially since that point, where like the Fed's hiking um, like one over and forced the commodity complex, all of that to also roll over starting in I think it was June 2022. Um, but you're gonna start coming up with the conflict of, hey, what's happening to commodity prices as a result of the tariffs going into effect. And this is where it's an important wait and see. But this may represent a kind of a cyclical bottoming for that, CPI measure. We've talked about the 2% goal, right? Fed's talked about its mandate, starting in August of 2020 to average out to the 2% target, which is nowhere even close to meeting. Even if you take that average over a long-term time period, um, you'd have to see like zero inflation between now and well beyond the end of this decade to average out to 2% annual at this point. But you're going to be at an interesting point, say where it looks like the right thing for the Fed to do is to cut rates, but CPI may actually, starting with this July print, showing a kind of a cyclical bottoming of that long-term process from midway through 2022 up until let's call it June of 2025, right, where we get over the hump of that first wave impulse of price level increase in the global dollar system, materializing at that like a 9% CPI peak. If you recall those at the early part of 2022, you're going to be at an interesting point where all of these kind of mandates that the Fed kind of operates on, full employment, stable prices, those are the top two. But at the other side of it, you've also got the big concern over helping out the Treasury's own budget situation, which I think probably takes precedence over the that 2% stable prices mandate. Um, I think the benefit to the Treasury lowering the debt service kind of wins out in Washington D.C. And ultimately you're going to see an FOMC, whether it's sooner or later, that kind of bends to what we've seen the Treasury and the White House itself advocate as its new policy. We're going to run this hot. We're going to grow nominal GDP above the growth rate and debt. So bottom line, it's going to be it could be easy way, or I guess the other way, as Trump said with the Iran thing, but it's the same thing here. We're gonna get the cuts. It's gonna come through the market. Now, like through the FOMC kind of committee policy implementation, they need a reason now. And so you've already seen, if you look at kind of the June press conference, you've already talked about, you've got the FOMC essentially split into two camps. You've got a camp who wants to wait and see. Maybe it's 50-50 here on the votes. You've got a camp who wants to wait and see, hey, does inflation start to tick up as a result of everything that happens? You call them the hawks, but none of them are really hawks. They're all going to fold, once the check comes due. And then you've got another camp, starting with, I guess you could say Christopher Waller seems like the front man on this with what he said last Friday. He came out in his kind of talking heads, circuit, came out in his statements as he's okay with cuts coming over the remainder of 2025, right? And so you've got those two factions. Ultimately, like, direction and rate of change is your best guide. So if half of the committee, say like up until, let's say, June, everybody was comfortable. Yeah, I like where we're at. Wait and see. Pause
See,
here. You've got half now essentially who are in the camp, lower cut. And you're just going to continue to see, as the economic data prints come in, more and more pressure, because look to markets as your guide. What's happening in the treasury curves? Despite all of the headlines about, it's the kind of thing, if it leads, it leads, like 20-year auction tails a bit, or, something like that, a bad 20-year auction. Everybody thinks the bond market is, kind of experiencing the same sell-offs that you saw in like 2022, like that same vibe. That hasn't actually been what's going on under the surface. Bond market's up, like it's getting close to up almost 4% for year to date for the U.S. Bloomberg Ag. Yields are doing part of that work in terms of just accrued interest, but then also yields are actually cyclically trending lower over those last 6 months. Now, it hasn't been a massive smash buy into yields, cut to zero, all of that, but yields have had a tailwind for price appreciation on bonds. So my point is, if you take roughly, call it 4% for half one of 2025, bond investors are like good with that. Like, that's what they want to see. Like, they're not in bonds for, an 8 or a 10, typically, as you would for like an equity allocation target expected return. Bond market investors, they're perfectly fine with what's been happening over, let's say, 2025 so far. Like, granted, there have been some touch and go points along the way, but by and large, like over the entire body of work, I'd say your bond investor is perfectly fine where things are, as they stand today. So I would say, yeah, just everything looks like it's coming into play. We talked about the sequence of events, right? Get the one big beautiful bill done, then you get the rate cuts, then you get, whatever. Move
right.
move on to the next thing.
So, and then to segue then to move on to the next thing, we've been talking about some of this privatization of Fannie Mae, Freddie Mac, and so, for me, it isn't necessarily clear how this fits into the overall picture of what we've been talking about, right? So I'm curious from your perspective, is the privatization push related to some of Trump's goals or the admin's goals around monetary policy? It doesn't seem like it would necessarily be directly related.
It's 100% related, and let me try to like communicate this, like why it all matters, and how is this connected, from a structural standpoint. So I think it was last week, right? We talked about the housing print. It was also item number 3. It was the tailwind, so we buried the lead. Um, but we showed new housing starts, right? Disappointed, tremendous. Like, it was a down print. It missed forecasts. And what that's telling you is there's a slowdown in demand for home building, right? And ultimately, like, why do you slow down? Well, it's because your ultimate end customer is giving you a
Leading
signal
indicator. Yep.
signal that they're not there, right? So if you look at how do you how do you finance a house? Like most housing in the US is financed on credit, right? And you're looking at mortgage rates. I don't see what look up what the bank rate 30-year is. It's probably come in a little bit, but you're still looking at like 6.5 to 7% interest rates, even if you qualify to finance, a home purchase, right? What is that dependent on? It's dependent on your income, right? So like, do you have a job, and then what does your income look like? Um, Most home borrowers, um, you could say they're actually buying a payment, not a house, right? It's what can they afford, right?
Right.
So that slowdown in credit creation coming from home mortgages, right? That's part of your kind of your monetary expansion, right? To get economic growth, which we just choose everybody foots to GDP, whether that's the right target metric is up for debate. But I'm not going to touch that one here. But from a policy standpoint, all the institutions that this system has been designed around, right? What do you need? If you need GDP growth, right, you need credit expansion, right? So if you start seeing your U.S. households, your new borrowers, your 20-year-olds, your 20-year-olds, 30-year-olds, et cetera, starting to pull back. Hey, I'm not going to buy a house at these prices or these interest rates. Why? Because I can't afford it, right? It's not feasible. If I could, I would, but they can't. All right. How do you make that happen? Well, you don't want to see deflation in prices, over the long term, right? Because what's that doing? Well, if you're the collateral for a home mortgage is not just the house, but it's also the price, right? And if you let prices go down, you see a deflationary real estate industry. That's what China looks like right now. That's a bad thing. You don't want to see that from a policymaker's perspective. So your best case is, all right, if I'm a policymaker, what do I want to see? I want to see unemployment rate, stay steady, right? So you manage unemployment, keep people in jobs so they have income, and then you want to see low or like reasonably low, enough rates so that they can afford the monthly mortgage payment, so that they can get in a house and rinse repeat. That's kind of the broader structure of the entirety of the U.S. economy, right? So what you've seen since 2008, Fannie and Freddie um, have been in conservatorship of the U.S. government, right? So we've got this PSPA system where we preferred shares that the U.S. Treasury holds on these entities themselves. So they've always been like quasi public-private entities, the other term, government-sponsored entities. Um, where does that actually come in? It comes in on the kind of the guarantee, implicit guarantee. It's not a congressional mandate, so they don't have to be on the hook. The U.S. Treasury doesn't have to be on the hook to bail out the system um, by kind of parliamentary authority. But what these, Fannie and Freddie are actually kind of set up to do is, like, their whole reason for existence is to make housing, mortgage financing, um, more available and affordable
Cheaper. Yep.
for the U.S. household, right? Okay. So part of this process, right, of solving, the current fiscal pickle that the U.S. Treasury finds itself in, right? How did they get here? Well, the U.S. Treasury did two big bailouts, 2008 and COVID in 2020, is really how we got here, right? And one of the large expenditures of 2008 was, hey, the bailout of Fannie and Freddie, along with bailouts kind of across the board, U.S. auto industry, et cetera, post 2008. But the U.S. is now sitting on these preferred shares, and then they've got some Treasury warrants as well. And so what you'd be looking at if you did IPO these shares would be kind of it'd be a cash inflow to the U.S. Treasury. As much as we talk about the U.S. Treasury, like the meme money printer go burr, um, it's not printing money to the degree like the way we think about it as like Weimar Germany, where you just see wheelbarrows of cash that are literally coming off the printing press. These are accounting entries, right? There's actual debt that's being created, that's being absorbed onto the public sector, right? So part of this kind of the debt problem that the US is in, one of the things we can do to get out of it would be to IPO Fannie and Freddie, and then they exit conservatorship, which will allow them to kind of operate as kind of profit-seeking enterprise, for their shareholders, which there's a lot of ifs there on what this means for borrowing rates for U.S. kind of households to go out and buy their first home. Um, but from the Treasury's perspective, you look at what would this do to the public debt situation, right? The GSE equity value that I've circled here, just based under three assumptions. This is coming from a research piece I received from TD Securities yesterday. But you're looking at anywhere from roughly 300 billion to 500 billion dollars, with, if you will, of inflow to the U.S. Treasury, right? So on $37 trillion in debt, that's a drop in the bucket. But what would this do for the kind of the next, like the short term? What you're doing with your financial house, getting your affairs in order. Um, this would be a massive kind of like cash inflow into the Treasury's purse. And in terms of order of operations, right? We talked about get one big beautiful bill passed. If you're taking this from the Republican perspective in Washington D.C., which is holding the keys to power right now, right? You get one big beautiful bill kind of passed, signed, etc. You get the rate cuts, then you do this, right? And this brings in anywhere from like on the first order impact, you raise you know, in the ballpark of half a trillion, right? Which is doesn't solve your problem, but it's a big inflow. And then you can continue trying to get the your house in order from spending standpoint. And then the last shoe to drop here on this front, this is where we're trying to put all the pieces together and make sense of this narrative. If you're watching us at this point, one of our few followers, you're probably already kind of favorable in terms of your outlook on Bitcoin. You see it for what it is as a kind of a sound money, open, public, immutable ledger. But the tea leaves are already there on where this is going. If you look at the filing yesterday, or the policy communication from the FHFA chief, who really oversees Fannie and Freddie, he says prepare to count crypto holdings in your mortgage underwriting process. So what does that mean? Up until this time, like let's say you held Bitcoin as a U.S. household, you're a taxpayer, great, you're paying capital gains on it, whatever. But from your mortgage underwriting, I think there's countless individuals here across the U.S. who have gone through this experience. When you go through your application process and you're listing your assets, you're listing your income, you're showing your W-2s, it's a long process, right? To obtain a mortgage, right? That would be Fannie or Freddie compliant. It can get bundled, packaged, and stamped with the guarantee from these GSEs, and then plugged into a mortgage-backed security and works its way into the kind of the U.S. credit system. They've been given guidance that they're going to start counting Bitcoin holdings in that underwriting process as an asset, where it used to just go down as a zero, right? Now there's some caveats here. They want it to be custodied with a qualified custodian, so you're self-custody on your own keys. Looks like that will not be accounted for, taken into consideration, which you're balancing trade-offs here. But what this represents, like to get the credit, right? To get yourself into 30-year or 15-year mortgage, to get you in the house, they're now going to acknowledge Bitcoin, but they want it to be parked with their, regulated qualified custodian. So that's the trade-off. But what they're telling you is, um, they said the quiet part out loud. They want to see Bitcoin in the collateral layer of their dollar credit underwriting that's taking place. So huge development, but as you're kind of watching, all of these narratives unfold. Like we started in Iran with Ford out, Banks Apa, what's going on, try to give you, make sense of what's happening. Underneath all that, Bitcoin is just continuing to, blocks are coming in every 10 minutes. But what you're seeing is increasingly more and more counterparties are aligning around this, you know, decentralized ledger, like the decentralized solution to the economic coordination problem, the Byzantine generals, if you will. Um, and this is kind of the big process of what all of the rest of these developments, these architectures, Iran, China, EU, all of that, like the foundation is actually, my opinion, my framework is the 21 million UTXOs. So that one very quietly under the scene, that FHFA chair's policy memo this week is your signal amidst the noise.
Well, man, I think that was a great wrap up conclusion to today's episode. So let's go ahead and just leave it there. Well, thank you
Cool.
to our viewers for watching. Again, if you are not yet a subscriber, please subscribe to us on YouTube, X, LinkedIn. Appreciate everybody's comments. We do notice we have some repeat viewers. So again, thank you so much. See you all next week.